Okay, let's dive in. Buying your first place in Canada. It's this huge mix, right? Super exciting. You start imagining everything.
Mm-hmm. Possibilities.
Yeah. But then the actual how
Yeah.
it hits you suddenly feels like this massive maze of like forms and terms you've never heard before. Overwhelming.
It really can be. Enthusiasm meets this wall of information. It's tough knowing where to even start, especially for you, the learner, just beginning.
Exactly.
Oh,
And that's what we do here. Welcome to the deep dive. You sent us this source, the Canada Real Estate Beginner's Guide, and, well, our mission is to pull out the really crucial stuff for you.
Cut through the noise, yeah.
Think of it as your shortcut, getting you up to speed, feeling informed, but without, drowning in the details yourself.
And we want to go a bit deeper than just definitions. We'll try to give you the why behind things, the context, so you can see how it all fits together for your own journey.
So today, it's all about cracking open this beginner's guide. We're aiming to demystify the whole Canadian home buying thing for you. Your fast track to understanding the essentials so you can move forward feeling, well, confident instead of confused.
And this guide, it really does cover the bases. It starts with, like, the legal ways you can own property, which sounds dry, but it's huge.
Right.
Then it goes into the different kinds of houses you see, understanding market buzzwords, getting financing, the actual steps.
All the costs involved, not just the price tag.
Exactly. And taxes, how they play a role, it's pretty comprehensive.
So our goal today, equip you with that core knowledge. Enough to navigate the Canadian scene confidently, make smart choices. We're definitely going beyond just skimming.
And I'm here to help connect those dots, maybe offer some perspective.
Perfect. Now, first impressions of the guide. Anything jump out?
You know, what I liked is right near the start, it highlights something critical. Real estate is local. Super local.
Ah, yeah, that's key, isn't it?
Totally. What's happening in, say, Toronto's market might be completely different from Calgary or a small town somewhere. Provincial rules differ, city bylaws, market conditions, obviously.
So while this guide gives you the Canada-wide foundation, you absolutely need local expertise.
That's what it stresses. You need people on the ground. An agent who knows the specific neighborhoods you're looking at, a mortgage broker familiar with local lenders, a lawyer who practices in your province, a home inspector who knows the common issues in your area.
Right, for that personalized advice. Okay,
Right.
makes sense. So the guide kicks off with understanding property ownership. Why start there? Why is that the absolute first step?
Because, fundamentally, how you legally own the property shapes everything else. It determines your rights as an owner, what you're responsible for, the costs you'll face, and honestly, how much freedom you really have.
Okay.
The guide focuses on the main types in Canada: freehold, leasehold, and then condominiums or strata.
Got it. Let's tackle freehold first. What's the core idea there?
Freehold is, well, it's basically the most complete ownership you can have. Think of that classic detached house with a yard.
Okay.
You own the building and the land it sits on, essentially forever or, indefinitely. It's the most common and maybe the simplest form to grasp.
So what are the big pluses? Why go freehold?
Control.
Yeah.
That's the big one. Maximum control. You want to renovate the kitchen, paint the house purple. Generally, you can, as long as you follow local bylaws.
Right. No landlord telling you no.
Exactly. And you've got the freedom to leave it to whoever you want in your will. There's no lease expiring. It feels very autonomous.
Sounds good. Liberating even. But what's the flip side? What are the responsibilities that come with that freedom?
Well, the flip side is all the responsibility lands on you. Every single bit of maintenance and repair.
Not just inside stuff.
Nope. Inside, outside, the roof, the driveway, the lawn, even the pipe connecting your water to the street main, usually up to your property line. It's all yours to fix and pay for.
Okay, wow.
Plus, you pay the property taxes on the whole thing, land and building. And you need comprehensive home insurance to cover it all.
So the key insight for you, listening. Freehold means total control, but also total responsibility for upkeep and all the costs. Okay, let's switch gears. Leasehold. Sounds quite different.
It is, fundamentally. With leasehold, you own the structure, the house, the unit, but you don't own the land underneath it.
Ah, so who owns the land?
Someone else. Could be the government, a First Nations band, maybe a university, sometimes even a private company. You're essentially leasing or renting the land from them for a set period.
How long are we talking?
It varies a lot. Could be 40 years, could be 99 years, sometimes even longer, but it's always a fixed term.
Okay, so as a leasehold owner, What can you do? What are the limits?
You have the right to live there and use the property, but it's all governed by the lease agreement, so you definitely have less freedom than freehold.
Like with renovations.
Yeah, big changes might need the landowner's okay, and the lease might have other rules. But the absolute crucial thing is, it's finite. When that lease term ends, your right to be there ends too, unless you can negotiate a renewal.
That finite part adds a whole layer of complexity, doesn't it? What about responsibilities? Is it like freehold for the building part?
Generally, yes. You're usually responsible for maintaining the building itself. The difference often comes with taxes.
How so?
Typically, you only pay property taxes on the value of the building. The landowner handles the taxes on the land itself. Though, realistically, they probably factor that cost into the rent they charge you for the land.
The ground rent.
Exactly.
Right.
And for insurance, you usually only need to insure the building you own. The landowner worries about the land upkeep, unless the lease says otherwise.
Okay, so financially, lower upfront cost maybe.
Often, yes. Leasehold properties can have a lower purchase price initially, which might make them seem more affordable, especially in expensive cities.
But there's always a but.
But you have that ongoing ground rent payment every month or year, whatever the lease says. And there might be other fees hidden in the lease terms.
And what about value? Does it appreciate, like, freehold?
Generally not as much because you don't own the appreciating asset, the land. And getting a mortgage can sometimes be trickier, especially if the lease has, say, only 20 or 30 years left on it. Lenders get nervous if the lease might run out before the mortgage is paid off.
Right, so that lower entry price needs careful weighing against the ongoing rent, the limited control, and that ticking clock on the lease. The guide mentions leaseholds can be found on government land or First Nations land. That's interesting.
It really shows the diversity of ownership models in Canada, often tied to specific land governance or history.
Okay, let's move to the third main type, condominiums and strata. The guide's very clear. This isn't about the style of building, but the legal way you own it. Can you unpack that?
Absolutely. You could be looking at a downtown high-rise apartment, a row of townhouses, even some detached homes in a planned community with shared stuff. They can all be set up as condominiums, or strata, which is the term they use in BC.
Okay, so what's the core concept?
It's a mix.
Yeah.
You own your individual unit privately, the space inside your walls. But you also share ownership and the costs and the responsibilities for all the common property with everyone else in the development.
Common property being, like hallways, elevators.
Exactly. Hallways, lobby, elevators, the roof, exterior walls, maybe a gym, pool, parking garage, the grounds, the building's basic systems. All that shared stuff.
And who manages all that?
And pays for it. That's where the condominium corporation or strata corporation comes in. It's a legal entity set up just to manage the whole complex.
Run by.
It's governed by a board of directors, elected by the owners themselves. And often, they hire a professional property management company to handle the day-to-day things, like collecting fees, arranging repairs, dealing with contractors.
So as a condo owner, what are my rights and my duties?
Your rights usually include voting on major decisions for the corporation, running for a spot on the board, accessing the corporation's financial records, and of course, using those shared amenities.
And the obligations.
The big ones are paying your monthly condo or strata fees on time, following the corporation's bylaws and rules, which can cover noise, pets, even balcony decorations, and maintaining the inside of your own unit.
Those monthly fees are a big deal. What exactly do they cover?
They cover the operating costs for all that common property. So cleaning, landscaping, snow removal, utilities for common areas, the master insurance policy for the building structure itself.
Okay.
And crucially, a slice of those fees goes into a reserve fund. That's like a mandatory savings account for future big-ticket repairs, replacing the roof in 10 years, overhauling the elevators, things like that.
And these fees are on top of your mortgage and property taxes for your unit.
Correct. They are an additional ongoing cost. And the fee amount is usually tied to the size or unit entitlement of your specific unit compared to others in the building.
Now, the guide says condos can be freehold or leasehold. How does that work?
It's similar to other property types. The entire condo development itself might own the land underneath it outright. That's a freehold condo. Or the entire development might be built on land that the condo corporation is leasing from someone else. That's a leasehold condo.
And if it's a leasehold condo?
Then your ownership of your unit and your share of the common elements is tied to that underlying land lease. The ground rent for the land usually gets baked into your monthly condo fees, And like other leaseholds, when that mainland lease expires, the owner's rights expire too, unless the corporation can renew it.
Okay, adds another layer. Then there's this thing, especially in BC, called freehold strata. Sounds like a hybrid.
It kind of is. With a freehold strata, you actually own your individual house and the plot of land it's on. Freehold. Just like a regular detached house in that sense.
What?
But you're also part of a strata corporation that manages shared amenities. Maybe private roads in the complex, a shared park area, a clubhouse. You pay strata fees for those shared things, and you follow the strata rules.
So who maintains the house itself?
You do. Typically, in a freehold strata, you're responsible for all the maintenance of your own house and yard. This often means the monthly strata fees are lower than in a traditional condo where the corporation handles exterior building maintenance.
Interesting. So, independence of freehold for your house, but shared costs and rules for communal stuff. The guide also briefly mentions cooperative housing. How's that different?
Co-ops are a different model altogether. Residents don't technically own their individual unit like in a condo. Instead, you buy shares in the cooperative corporation that owns the entire property.
Okay.
Those shares give you the right to occupy a specific unit. Co-ops usually have their own unique rules about who can join, how shares are transferred, and how involved residents are in running the place.
So you're buying into the collective, not buying the specific real estate. Got it. The guide has a great summary table comparing all these freehold, leasehold, condo across control costs, responsibilities.
Yeah, that table is super useful. It really lays out the trade-offs side by side. You see freehold's control and appreciation potential versus the cost and upkeep burden. Leasehold's lower entry versus the rent and finite term. Condo convenience versus the fees and rules.
It hammers home that you really need to think about your own finances, your lifestyle, what you value most when choosing which ownership type fits you best.
Absolutely. It's not just about the four walls. It's the whole legal and financial package you're signing up for.
Okay, solid foundation on ownership. Now, the guide shifts to the physical types of homes. Why is understanding these different styles important for you, the learner?
Because the type of building, detached, semi-townhouse, apartment, directly impacts your day-to-day living. Things like space, privacy, how much yard work you'll do, maintenance levels, and of course the price tag. Canada's got a real mix of housing styles.
Let's start with the one everyone pictures. The detached home. What's the definition?
Simple enough. A standalone house, doesn't share walls with neighbors, sits on its own piece of land. Usually it's freehold ownership.
The big pros.
Maximum privacy, your own space yard, driveway, full control, generally.
And the main downside.
Usually the most expensive option. And, as we said with freehold, you're on the hook for all the maintenance, inside and out.
The guide mentions different styles within detached homes, too. Bungalows, two-story, split levels. Why does the style matter?
It affects how you live in the space. A bungalow, being all on one floor, is great if you hate stairs or have mobility issues.
Right.
A two-story usually gives you more square footage on a smaller lot. A 1.5-story might have those angled ceilings upstairs, which can be charming but reduces headroom. Split levels work well on sloped lots. A high ranch has the main living area raised up. Even cottage can mean anything from a tiny cabin to a huge luxury lake house.
So the style dictates layout and function, not just looks.
Okay, what about semi-detached? How do they stack up? Semi-detached means two houses joined by one shared wall. Each house is on its own separate lot, often mirror images of each other.
The balance, maybe.
Yeah, often a good middle ground, more affordable than fully detached, usually still have decent privacy and often a yard.
The compromise.
That shared wall, less soundproofing than detached. And you might share a driveway or fence. Each owner takes care of their own side.
Makes sense. Less space, maybe, lower price, smaller yard, perhaps. Now, townhouses are row houses. The guide flags a key difference here.
Yes, this is critical. Townhouses are built in a row, sharing one or both side walls, usually multi-level. But the crucial part is, are they freehold or condominium townhouses?
Explain the difference.
Freehold townhouse. You
Yeah.
own the unit and the land it's on. You're responsible for all maintenance, inside and out, just like a detached condominium townhouse. You own the inside space only. The exterior, the land, any common pathways or yards are owned and managed by the condo corp. You pay monthly condo fees for that upkeep.
So you absolutely need to know which kind it is before you buy. Big difference in costs and chores.
Huge difference. The guide also mentions stacked townhouses. What are those? They're basically townhouse units built vertically, one on top of another, each with its own separate entrance. You see them more in dense urban areas.
Right.
More efficient use of land, often making them a more affordable way to own property in pricey cities. The trade-off is you might have neighbors above or below you, plus beside you.
Got it. Maximizing density, potentially lowering cost. Now, apartment-style condos. We know the condo ownership part, but what about the physical space?
These are individual units within a larger building, could be a low-rise walk-up or a towering high-rise. Ownership is condo strata.
Advantages.
Often the most affordable entry point, especially in cities. Convenience is a big one. Exterior maintenance is handled. Plus, potential amenities like gyms or party rooms.
Disadvantages.
Less privacy neighbors close by, shared walls, floors, ceilings, those monthly condo fees, rules and bylaws you have to follow. And usually limited private outdoor space, maybe just a balcony.
And just to clarify, condo was ownership. Apartment usually means rental. The guide mentions lofts, too.
Yeah, lofts are often a style of condo or apartment think, open concept, high ceilings, maybe exposed brick, often in converted old industrial buildings.
Right, more about the aesthetic. What about duplexes, triplexes, fourplexes? They sound like potential income generators.
Exactly. These are single buildings divided into 2, 3, or 4 separate self-contained units. Often, the whole building has one owner.
So you could live in one unit and rent the others?
That's the classic scenario, yeah. It can help cover the mortgage. Lifestyle might be similar to a semi in some ways, but the single ownership structure changes things for financing and management compared to, say, 2 separate semi-detached homes.
And the guide briefly mentions mobile homes and basement apartments.
Mobile homes are factory built, often in parks where you own the home but lease the land, so leasehold land again. Basement apartments are units within a house, often rented out. The key thing there, as the guide stresses, is making sure they're legal and meet all the local codes for safety.
Wow, okay, a huge range of options.
Mm-hmm.
Again, the guide has a handy table summarizing these types. Pros, cons, typical ownership, price range. It really drives home that you need to balance your budget, lifestyle, and how much maintenance you're up for. Okay, we've got ownership types and housing types down. Next big question the guide tackles. Timing. When is the right time to buy? Feels like everyone's got an opinion.
Oh, definitely. And the guide gives a good framework by talking about market cycles. Real estate markets go up, they go down, they level off.
Driven by.
A mix of things. Interest rates are huge, the overall economy, jobs, confidence, population changes, government policies. It all affects supply, how many homes are for sale, and demand, how many people want to buy.
And understanding whether it's a buyer's market, seller's market, or balanced is key.
Absolutely crucial for making smart moves.
Okay, let's paint a picture. Seller's market. What does that look like?
High demand, low supply.
Yeah.
Lots of buyers chasing fewer listings.
So what happens?
Homes sell fast, like really fast. Often multiple offers, bidding wars, pushing prices up, sometimes way over asking.
Yeah.
Sellers have the upper hand in negotiations, fewer conditions accepted, less wiggle room on price.
So if you're trying to buy your first place in that kind of market, what should you expect?
It's tough.
Yeah.
You need your ducks in a row, mortgage pre-approval lockdown, be ready to see a place and decide fast. You might face bidding wars.
And conditions, like financing or inspection.
You might feel pressure to make offers without those conditions to be competitive. That's risky, though. Really risky. You need to weigh that carefully, get advice. Patience helps, too, because finding the right place might take time even if things are selling quickly.
Sounds stressful. Okay, flip side. Buyer's market. What's the vibe there?
Opposite situation. Lots of homes for sale, fewer buyers actively looking, high supply, low demand, homes sit on the market longer. Prices might be stable or even drifting down as sellers compete. Buyers have more choice, more time, and way more negotiating power.
So sellers need to be more flexible.
Usually, yeah. More willing to negotiate on price, maybe agree to conditions like repairs or leaving certain items. They need to make their properties stand out.
So for you, the learner, a buyer's market means less pressure, more time for inspections and due diligence, and a stronger position to bargain.
Pretty much. You can take your time, compare options, negotiate harder on price and terms. You might even get a deal below the asking price.
Okay, seller's market, buyer's market. What about the middle ground balance market?
That's the sweet spot, sort of. Supply and demand are roughly equal. Homes sell at a reasonable pace. Price growth is usually moderate, maybe matching inflation.
And negotiations.
More balanced, too. Give and take from both sides. Buyers can usually include reasonable conditions. Sellers can expect a fair price without crazy bidding wars.
Okay, so how do you figure out which market you're actually in? The guide mentions key indicators.
Yeah, there are stats you can track. A big one is the sales to active listings ratio, or SL ratio.
How's that work?
Simple calculation. Number of sales in a period divided by the number of active listings at the end of that period. The guide gives benchmarks consistently over 20%, likely a seller's market, below 12%. Leaning towards buyers, in between, probably balanced.
So higher ratio means things are selling faster relative to supply.
Exactly. More sales compared to listings points to seller advantage.
What else did you look at?
Average days on market. How long does the average home take to sell? Low DOM suggests a hot seller's market. High DOM points to a slower buyer's market. But remember, seasonality and property type can affect this too.
And the guide mentions the MLS Home Price Index, HPI. Says it's better than just average prices.
Yes, because the HPI tracks price changes for a typical or benchmark home with consistent features over time. Average or median prices can get skewed easily if, say, a bunch of luxury homes sell 1 month, making the average jump even if typical home values didn't.
Ah, so HPI filters out those weird swings based on what's sold.
Right. It gives a cleaner picture of underlying price trends for standard properties.
What about just the number of listings inventory?
Definitely important. Total inventory is just the number of homes for sale. You can also look at months of supply that's inventory divided by monthly sales. It estimates how long it'd take to sell everything currently listed. Low months of supply, like under 4 months, usually signals a seller's market.
At MLS, that's the multiple listing service the big database agents use.
Correct. It's the cooperative system agents use to share listings. The public sees a lot of it on sites like Realtor.ca. And a realtor is an agent who's part of the Canadian Real Estate Association, CREA, meaning they follow a code of ethics.
Now, here's that crucial point again. Market conditions are super local.
Absolutely critical. National news gives context, but the market in your city, even your specific neighborhood, could be totally different. Different dynamics, different pressures.
So you really need to focus on the data for where you want to buy.
100%. Talk to local agents, look at local board reports, and, sometimes life just happens, new job, family changes, and you need to buy regardless of the perfect market timing.
Right. But understanding the local market helps you strategize with your team. The guide's comparison table for market types what's really useful for a quick check. Okay, market assessment covered. Next big hurdle, getting the finances sorted. This feels like where a lot of first-timers get bogged down.
It can feel daunting, for sure. But the guide breaks it down logically, starting with the absolute baseline, a realistic budget for owning a home. And it stresses it's way more than just the mortgage payment.
That's a huge point.
Right.
What else needs to be in that budget beyond principal and interest?
Okay, deep breath. Property tax is an annual cost. Utilities, heating, electricity, water, sewer, home insurance mandatory, condo fees, if applicable, monthly.
And the big one people forget.
Maintenance and repairs. You need to budget for ongoing upkeep and save for big replacements down the road, roof, furnace, windows. The guide mentions a CMHC guideline. Budget may be 1-3% of the home's value each year for this stuff.
That's a great rule of thumb for you to remember, 1-3% annually. And factor in potential cost increases too, right? Like interest rates going up at renewal.
Definitely. Or taxes, utilities. Costs rarely stay static. Online calculators are okay starting points, but they're just estimates. Your actual costs will be specific to your property and situation.
Okay. Next financial pillar, credit score. Why is this so vital?
Your credit score is like your financial reputation score. Lenders use it to judge how risky it is to lend you money based on how you've handled debt before.
So good score equals better mortgage options.
Generally, yes. A strong score helps you get approved and hopefully get a better interest rate. A poor score can mean denial or paying a lot more in interest if you get approved at all.
So the advice is check your score early.
Way early. Get reports from both Equifax and TransUnion. Check for errors. If it needs work, start now. Pay bills on time, lower credit card balances, maybe avoid applying for new credit right before mortgage application.
Got it. Now, the down payment. Often the biggest saving challenge. The guide outlines the minimums in Canada.
Yeah, it depends on the price. Up to $500, minimum is 5%. Between $500K and $1, it's 5% on the first $500, then 10% on the amount above that. Over $1, you need at least 20% down.
And putting down more than the minimum is usually better.
Generally, yes. Less money to borrow means lower payments, less total interest paid. Plus, and this is key, if you put down less than 20%, you almost always have to pay for mortgage loan insurance.
Explain that again. Who does that insurance protect?
It protects the lender, not you. If you default, the insurer covers the lender's loss, but you pay the premium for it.
How much is it?
It's a percentage of the loan amount, often added to your mortgage principal, meaning you pay interest on it too. Reaching that 20% down payment mark avoids this extra cost entirely.
Okay, so hitting 20% is a big milestone. Where can the down payment come from? Savings, obviously.
Personal savings, yes. Gifts from immediate family are usually okay, but you'll need a formal gift letter saying it's not a loan. And then there are government programs.
Like the home buyer's plan.
Right. The HBP lets eligible first-time buyers borrow from their own RRSPs tax-free for a down payment. There are limits, and you have to repay it back into your RRSP over time.
And the newer one, FHSA.
The First Home Savings Account. This one's great. Contributions are tax-deductible, like an RSP. Growth inside is tax-free. And withdrawals to buy your first home are also tax-free. You can even use it alongside the HBP sometimes.
Wow, those sound really helpful for first-timers. And lenders need proof of where the down payment came from, right?
Absolutely. They'll want bank statements, investment statements, that gift letter, etc. Finally, the guide says, gather your documents early. Proof of income, down payment proof, ID, list of assets and debts.
Having it all ready makes the mortgage application smoother.
Much smoother. Okay, finances prepped. Now, actually getting the mortgage. This is where things get real.
Yeah, choosing the right mortgage feels critical. The guide starts with basics, principal, interest, term, amortization. Let's quickly define those for you listening.
Okay. Principal is the amount you borrow. Interest is the bank's fee for lending it to you, the cost of borrowing. Term is the length of your current mortgage contract. Could be 1, 3, 5, 10 years. 5 is common. At the end of the term, you renew or refinance.
And amortization,
Yeah.
longer.
Much longer. Amortization period is the total time plan to pay off the entire loan, often 25 years for insured mortgages. Shorter amortization means higher payments but less interest paid overall. Longer amortization lowers payments but costs more interest in the long run.
And payment frequency.
How often you pay? Monthly, semi-monthly, bi-weekly, weekly. Accelerated options pay down principal faster, saving interest.
And early on, most of your payment is interest. Less is principal.
That's right. The balance shifts over time. Okay, types of mortgages. The big debate. Fixed versus variable rate.
Fixed rate means
Your interest rate is locked in solid for the whole term. Your payment amount won't change. Predictability.
variable rate.
The rate floats up or down, usually tied to the lender's prime rate, which follows the Bank of Canada. Payments might stay the same, but more or less goes to principal, or the payment itself might change. Potential savings if rates drop, but risk if they rise.
And open versus closed mortgages. That's about paying extra.
Exactly. Open mortgages let you pay extra, even the whole thing off, anytime without penalty. But they usually have higher interest rates.
Closed.
Closed mortgages have lower rates, but strict limits on how much extra you can pay each year or how much you can increase payments without penalties. Paying it all off early before the term ends usually triggers significant penalties.
Okay, lots of choices there. Now, getting pre-approved before house hunting. The guide strongly recommends this. Why?
Oh, it's huge. A pre-approval is the lender's initial assessment. They tell you roughly how much they might lend you based on your info so far.
Benefits.
Show sellers you're serious, tells you what price range to realistically look in. Often locks in an interest rate for a few months, protecting you if rates go up while you search. It just makes the whole process smoother and more focused.
Makes sense. Now, the mortgage stress test. This confuses people. Can you break it down?
Okay, it's a rule mainly for federally regulated lenders.
Right.
They have to check if you could still afford your mortgage payments if interest rates were higher than your actual contract rate.
How much higher?
You need to qualify at the higher of two rates, either 5.25% or your contract rate plus 2%. Whichever number is bigger, that's the rate they test you against.
Even with a big down payment.
Yep, even with 20% down or more, typically. It applies to new mortgages, refinancing, sometimes switching lenders.
What's the point?
It's a buffer. It reduces the maximum amount you can borrow slightly, but makes sure you likely won't be financially crushed if rates rise significantly when your term is up for renewal.
Okay, a safety measure, basically.
Yeah.
Mortgage loan insurance, again, reminder, mandatory if less than 20% down.
Correct. Protects the lender. Providers are CMHC, government-backed, Sagen, Canada Guarantee, private. You pay the premium, usually 0.6% to 4% of the loan, often rolled into the mortgage. Might be sales tax on the premium up front in some provinces too. It adds to your total borrowing cost.
Lenders also use ratios to see if you can afford the payments, right?
Yeah.
GDS and PDS.
Yeah, key calculations. Gross debt service, GDS ratio, looks at your proposed housing costs, mortgage principal and interest, property taxes, heating, PITH, plus half your condo fees if applicable as a percentage of your gross monthly income. Lenders usually want this below, say, 32% to 39%.
And TDS.
Total debt service, TDS, adds all your other monthly debt payments on top of the GDS housing costs, car loans, student loans, credit card minimums, lines of credit, etc. That total debt load as a percentage of your gross income usually needs to be below 40% to 44%.
And you have to pass both ratios, calculated using the stress test rate.
Typically, yes. It's about ensuring you can handle the mortgage and your other debts. Online calculators can estimate these for you.
Okay, who helps you navigate all this? Bank specialist versus mortgage broker.
A mortgage specialist at a bank or credit union works for that one institution, offers only their products. A mortgage broker is independent, works with many different lenders, banks, credit unions, trust companies to shop the market for you.
Do you pay the broker?
Usually the lender pays the broker a commission, so there's often no direct fee to you as the borrower. But always confirm. The advice is always shop around, talk to your bank, talk to a broker, compare offers.
Great advice. Okay, finances lined up, pre-approval in hand. Now the exciting part, finding the place and making an offer. The guide walks through these steps.
Yeah, step 1 was preparation finances, pre-approval done. Step 2, build your team.
Who's essential on this team?
Your real estate agent, Realtor,
Okay.
represents your interests as the buyer. Finds properties, gives advice, handles viewings, writes the offer, negotiates, usually paid by the seller's commission. Your mortgage broker specialist gets the financing finalized. Your real estate lawyer or notary public handles all the legal stuff. Reviews the offer, searches title, prepares mortgage docs, manages closing funds, transfers ownership legally, protects your legal interests.
And the home inspector.
Crucial! Home inspector does a thorough visual check of the property's condition after your offer is accepted, usually. Looks at structure, roof, plumbing, electrical, heating, cooling. Identifies potential problems. You hire them directly. Get someone qualified and reputable.
Having a good team sounds invaluable. Step 3, finding the right home. What's key here?
Know your needs versus wants. Location, size, style, condition, must-have features. Use online listings, work with your agent, go to open houses.
And look beyond the surface.
Definitely. Check the layout, age of big-ticket items, roof, furnace, signs of neglect, neighborhood vibe, noise levels, even resale potential. See multiple properties to compare.
Found the one. Step 4, making an offer. The offer to purchase. This is serious, right?
Very. It's a legally binding document once accepted. Your agent prepares it. It includes the price, deposit amount, closing date, when you get keys, what's excluded, like appliances, and critical conditions.
Conditions the subject to clauses. These are buyer protections.
Exactly. Your safety nets, common ones are. Subject to financing, if you can't get the mortgage finalized. Subject to home inspection, if the inspection reveals major issues you don't accept. Subject to lawyer review of condo docs, if buying a condo. Subject to getting property insurance. Sometimes subject to selling your current home, but sellers may not like this one.
And the deposit.
Shows you're serious. Held in trust by a brokerage or lawyer, becomes part of your down payment at closing.
Then negotiation. Seller accepts, rejects, or counters.
Right. Your agent guides you. In hot markets with multiple offers, it can get intense, quick decisions needed.
Okay, offer accepted with conditions. Step 5, satisfying conditions. The due diligence period.
Yeah, usually a set time frame like 5-10 business days. This is when you scramble to get everything done, finalize the mortgage approval, conduct the home inspection, lawyer reviews, condo docs if needed.
And if everything checks out.
You or your lawyer agent provide formal notice, a waiver or fulfillment saying the conditions are met, the deal becomes firm and binding.
What if a condition isn't met? Like the inspection is bad?
If you followed the terms and timelines in the offer, you can usually withdraw from the deal and get your deposit back.
The guide warns about waiving conditions.
Big warning. Removing the financing or inspection condition is very risky. You could be legally forced to buy even if you can't get the money or discover huge problems later. Don't do it lightly.
Good advice. Okay, deal is firm. Step 6, preparing for closing. What happens now?
Lots of behind-the-scenes work. Lawyer does the title search, prepares closing documents, talks to the seller's lawyer, calculates the exact funds you need to bring. You arrange your home insurance to start on closing day. Lender needs proof. Book movers, arrange utility transfers, and do a final walkthrough of the property just before closing.
Final walkthrough. Why?
To make sure the property is in the agreed condition, all the included items, appliances, etc., are still there and working.
Makes sense. Then, step 7. Closing day. The big finale.
This is when ownership officially changes hands. You give the remaining funds, down payment balance plus closing costs, to your lawyer. Lender sends the mortgage money to your lawyer. Lawyers exchange funds and documents. Title gets registered in your name. Mortgage gets registered against the title.
Land keys?
Once funds are confirmed, transferred, and everything's registered, you get the keys to your new home. It's a complex dance managed by the lawyers.
Sounds like a relief when it's done. Now, we talked about the purchase points, but the guide has a whole section on all the other costs. This is where people can get surprised, right?
Absolutely. Underestimating closing costs is a common and painful mistake. The guide splits them into upfront costs around closing and ongoing costs after you move in.
Let's hit the upfront ones first. The guide suggests budgeting, quite a bit extra, on top of the down payment.
Yeah, plan for roughly 1.5% to 4% of the purchase price in addition to your down payment, depending on your location and the specifics.
Okay, what makes up that amount, besides the down payment itself?
Legal fees and disbursements for your lawyer notary, land transfer tax, LTT or PTT. This provincial municipal tax can be hefty, varies hugely by location. Research your local rates and any first-time buyer rebates.
What else?
Title insurance protects against title issues, often lender required. Maybe a property appraisal fee if the lender needs one. The home inspection fee you pay directly.
Mortgage insurance costs.
If less than 20% down, the mortgage loan insurance premium, plus potential PSTQST on the premium upfront in some provinces. Adjustments reimbursing the seller for things they prepaid, like property taxes or condo fees.
GST, HST.
Usually only on brand new or substantially renovated homes, not typical resales. Rebates might apply. Also, GST, HST applies to many services like legal fees, inspection fees.
Anything else?
Maybe a property survey fee or fees for condo status certificates. The point is, these add up fast. You need to estimate them accurately and save for them.
Definitely sounds like a significant chunk of change needed on closing day. Now, the ongoing costs, the ones you pay month after month, year after year.
Right. These need to be in your regular budget. Your mortgage payments, principal and interest, property taxes paid to the city, often collected by the lender with your mortgage payment PIT, home insurance, mandatory, covers damage, liability.
Utilities.
Yep, utilities. Heat, hydro, water, internet, phone, etc. Costs vary a lot. Maintenance and repairs, ongoing upkeep, lawn, snow, and saving for those big future replacements. Roof, furnace, remember that 1-3% guideline?
And if it's a condo?
Condominium strata fees, monthly payments for all the shared stuff. The big takeaway. Your true monthly housing cost is way more than just PIT.
Absolutely critical to budget for the full picture. The guide's table on typical closing cost ranges looks helpful for getting started. Okay, last major section the guide covers: taxes and real estate. Seems complicated.
It can be, but the guide hits the main points. How taxes affect you when buying, owning, and selling. We've touched on some already: annual property taxes, the upfront land transfer tax, GST, HST on new homes.
And the government programs.
Right. It revisits the home buyer's plan, HBP, for RRSP withdrawals and the first home savings account, FHSA, highlighting their tax advantages for down payments.
But the big one for homeowners is the principal residence exemption, right? What's that?
Huge benefit. The principal residence exemption, PRE, means when you sell your main home, the place you actually live, any profit, capital gain you make is usually completely tax-free.
Wow, completely.
Generally, yes. For the years it was your designated principal residence. You need to report the sale on your tax return to claim it. Rules get complex if you own multiple properties or rented part of it out, so get advice then. But for most people, it's a massive tax saving.
That's a really significant advantage. Any other tax credits mentioned?
The home buyer's amount, a small federal non-refundable tax credit for eligible first-time buyers, helps offset closing costs a bit. Provincial credits might exist too. And the Home Accessibility Tax Credit, HATC, for renovations, making homes safer, more accessible for seniors or people with disabilities.
And if you rent out part of your home?
That rental income is taxable, but you can deduct related expenses. It can affect your PRE claim for that part of the house, so be careful. Taxes are definitely woven into the whole home ownership experience.
No kidding. It influences costs, helps first-timers, and offers that big PRE benefit. Okay, we've covered a ton of ground. Ownership, types, markets, financing, process costs, taxes. It's a lot. Thankfully, the guide ends with resources for you, the learner. Where should people look for more help?
Lots of great places. For unbiased info, government agencies are top-notch. CMHC, Canada Mortgage and Housing Corporation, amazing guides, calculators, market analysis, info on insurance and programs. FTC, Financial Consumer Agency of Canada, objective info on mortgages, costs, rights, great tools. Both have websites, easy to find.
And for tax stuff.
CRA, Canada Revenue Agency, is the source for HBP, FHSA, PRE, GST, rebates, the home buyer's amount. Their website has all the official details. These are reliable sources designed to help you.
Good to know. What about industry associations?
CREA, Canadian Real Estate Association, runs Realtor.ca for listings, has national stats, helps find agents. Local real estate boards, like in Toronto, Vancouver, Calgary, often have detailed local market reports. For inspectors, CAHPI, Canadian Association of Home and Property Inspectors, helps find qualified pros. Provincial law societies or notary groups list legal help. Mortgage Professionals Canada, MPC, is the association for brokers.
So lots of places to find qualified people and good information.
Definitely. Banks, credit unions, insurance companies, like through the Insurance Bureau of Canada, IBC, also have resources. The key is to use them.
So the message is, don't feel you have to know everything yourself. Tap into these resources, build your knowledge, connect with professionals. Okay, wrapping up this deep dive into the Canada Real Estate Beginner's Guide, buying a home here is clearly a big deal. Lots of moving parts.
It really is, but hopefully breaking it down like the guide does: ownership, housing types, markets, financing, the buying steps, all the costs, the tax angle makes it feel less overwhelming. It is manageable with good preparation and information.
And that's the goal, right? Empowering you, the learner. With solid research, careful planning, and a good team of pros, you absolutely can navigate this process confidently and make choices that work for you.
So dive into those resources we mentioned. Talk to agents, brokers, lawyers, inspectors. Get that personalized advice for your situation.
And maybe a final thought to leave you with. Remember that home ownership is a long game. It's a major financial step, yes, but also a huge lifestyle decision. Hopefully, armed with this knowledge, you feel ready to start that adventure.
Well said. It's a journey, but a potentially very rewarding one.
Absolutely. Well, thank you for joining us for this deep dive today. If you have other topics or guides you want us to tackle, send them our way. We're always ready for the next exploration here on the Deep Dive.